It is a true pleasure to be presenting to you, and I hope what you are going to hear today will excite you and stimulate your thinking and think about your career and your profession going forward. I want to start off by asking some rhetorical questions, and this should frankly determine your level of engagement in what we're about to talk about today. And the first question I want to ask for you to answer yourself, do you know an industry well? And what do I mean by do you know an industry well? Do you know how to make money in that industry? Do you know how to grow a company? And do you know companies that might be for sale in that industry? So that's somewhat of my definition of do you know an industry well? And typically that means you've worked in that industry for a period of time, but that's my definition. The second question I have for you, do you want to run your own company and have an ownership stake in it? Okay. The third question is, do you want to use OPM, other people's money, to do this? And then the last question I have for you before we get started is, do you know what an independent sponsor is? I've had this conversation with many individuals and with many groups, and I usually get a very strong yes to all the first sets of questions. And when I get to the question about, do you know what an independent sponsor is, I will typically get a blank stare from the people I'm talking to. And so the purpose of today's conversation is to talk about what an independent sponsor is and how it will help you achieve all the other goals that I talked about. So what I'd like to do is, first of all, give you my professional background. If I'm purported to be the expert on this, it would be nice to know that I have some credibility in having this conversation. I'd like to tell you about the company that I ran as an independent sponsor. I'd like to talk to you in detail about what the unfunded or independent sponsor model is. There's two terms given for the same thing. What are the pros and cons, and what are the economics of this model? And then finally, I like to talk about, well, what can I do to be helpful? And frankly, why am I giving this presentation today? So I'll give you a little bit of background. First of all, I grew up in Baltimore, Maryland, and I like to make it clear I'm an Orioles and a Baltimore Colts and a Bullets fan. For those of you who are old school into sports, two of those three teams don't exist anymore. I got my undergraduate degree from the Wharton School. I got a BS in economics from the University of Pennsylvania, and I got my MBA from the University of Chicago. And prior to beginning my career path as an independent sponsor, I worked for Morgan Stanley International in the mergers and acquisitions department, and I worked for McKinsey and Company in their Chicago office. I started when I left McKinsey, a startup company called the Career College Loan Company. And what that did was provide financing or student funding for individuals who were attending trade schools. I was in the for-profit education business after that, and as I will explain, as an unfunded sponsor, exactly the model that I'm going to share with you today. And my first time in that industry, or as an unfunded sponsor, was as the chief financial officer of a company called Education Corporation of America, and it did business as Virginia College. And I did that between 1999 and 2004. And then I started my own platform where I was a CEO and the founder of a company called Education Futures Group that did business as Vista College, and I did that for about 16 years. So again, this is the basis for which I am sharing this information with you today. Now, for those of you who are not familiar with the for-profit education industry, I'll give you just a quick primer. We're part of a very large post-secondary education market. We were in the private sector of that higher education, and we were in the for-profit sector. So the red boxes is essentially the business I was in, and I was in the Title IV, or the federally financial aid funded part of that industry. And over the course that I ran my company, we grew a campus that we had bought in El Paso, Texas, from 298 all the way up to 976 students. And when we added other campuses, we grew to over 3,300 students in the period of time that I ran the company. And commensurately with that, our revenue grew almost exponentially over the period of time that we were growing our company, as did the number of employees. So again, I present this to you by way of background and context to which I am sharing with you being an independent sponsor. Just to give you a brief snapshot on our financials, 8 years into the deal, we were up to about close to $60 million in revenue and got that up to over 80 million 3 years later. We were generating EBITDA of close to $7 million and on an adjusted basis, $8 million. How did we grow our company as rapidly as we did? We did a number of things. We opened campuses in new markets. We added new programs. In addition to the medical assisting and nursing and business programs, we added various other programs such as cosmetology and the trades. We began an online delivery of our programs. We went into programs that did not require federal financial aid. And then finally, we started teaching our programs in Spanish. So these were all the growth levers that we used to grow the company as dramatically as I showed you today. So I indicated that I exited that platform in 2021. So what am I doing today? Well, what I'm doing is I'm working with other independent sponsor candidates to realize the same experience I had. And that's essentially why I'm presenting today. I hope that many of you on this call are interested in pursuing the career that I did and would be interested in working with me to see that, to realize that. So what is an independent, or as I said, synonymously called a fundless sponsor? And basically, it's the individual, the executive, who is between the acquisition of a company and external sources of capital. It's the impresario. It's the individual who is pulling together the pieces to allow a company to be purchased by capital providers. These are individuals or groups that seek to acquire, grow, and exit one or more businesses, much like a conventional private equity fund. The biggest difference is they're using third-party equity. They don't have a dedicated pool of committed capital, and they're required to raise debt and equity and capital on a deal-by-deal basis. And what they are focused on are three things. One, proprietary deal sourcing, looking for deals or companies for sale that are not otherwise potentially for sale, making sure that the transaction gets executed, and make sure that the portfolio company or the company that they buy is run correctly. And there's often an opportunity for individuals to invest their personal funds as well. So independent sponsors fall under one of several categories. One, they are experienced operators. These are people who have been in the industry for many years and know the industry. That was the situation I was in. I had been the CFO of this education company. I spent 5 years learning the business at a very detailed level. And then when I was ready to start my own company, I had that experience to go do that. Or they could be private equity professionals, people who are already in that business, or it's an industry veteran who has access to off-market deals. And what they hope to do, and this is a key aspect and where an independent sponsor adds a great deal of value, is that they have a proprietary network of relationships that they can efficiently go to and access deals. There is a lot of capital out there to invest in these companies. There is a lot of interest in finding independent sponsors that are able to run these platforms. What there is not enough of are experienced executives to run these companies and access to these off-market deals. So how do people go out and raise money? And there's a number of different models. Some go and raise them in fairly small chunks for a pool, for as many as 50 small investors. That's one model of doing it. Another is to be backed by a single institutional investor. This was the model that I used. I worked in each of the unfunded sponsors situations I was in, a single private equity fund that provided all the capital I needed to grow. or they could work with a single family office or a handful of individuals, just a smaller number than the first one. For those of you who are not familiar with family offices tend to be, kind of as the name implies, um, funding or funds that are managed by typically third-party professionals to make sure that the wealth that the family has accumulated is well invested. And these are often very active participants in these independent sponsors deals. And what they have sought to do is diversify their portfolios. They don't want to run the companies. They don't want to build the infrastructure to do it. But what they do prefer to do is have passive board roles in this. And often working with a family office provides more favorable economics than potentially working with an institutional investor. But there are challenges in working with family offices, and it's key to find the right one if that's in fact the path you go down. One is connecting and networking with family offices, creating trust and chemistry between the investors and the executive who's running the company, the commitment of the family office, how much capital they have to allocate, and as inevitably happens in any business situation, being able to work through a tough time. And from the family office perspective, they have a couple of challenges themselves, making sure they're working with the right executives, making sure after they have built potentially a fair bit of wealth on their own through running their own companies, letting go of that, and the ability to be able to move quickly and transparently in order to get into these transactions. So there's several common stages in terms of a independent sponsor transaction. And the first is the pre-letter of intent. The letter of intent is a non-binding letter that will agree on the basic business terms of an acquisition, most importantly, the price. And one of the things that you do is, as the independent sponsor, in addition to finding the deals, is being able to have the basic outlines or the terms of the deal in place typically before you even go talk to any capital sources, so they know exactly, the potential investor knows exactly what they're potentially investing into. And then after the letter of intent stage, and this is typically at the point at which you would get a independent or a third party funding source involved, you would do the remaining due diligence, negotiate the final economics, potentially approaching third-party investors, and then negotiating the terms of the various capital stack in the transaction. So this is a relatively common form of how these independent sponsor deals work out. The independent sponsor and the investor will usually create a vehicle, a partnership, a limited liability corporation. They in turn will create a holding company that makes an acquisition. Often they'll bring in leverage, they'll bring in a bank to lever the deal. And that's how these transactions are put together. By the way, I do realize I am throwing a lot of detail at everybody today. Not only is this presentation being recorded, but the presentation itself will be available for anybody who is interested. And we got one question. Can an independent sponsor facilitate a deal for a company owned by one PE to another PE? And the answer is yes. It depends on who is selling the company, whether it's the family selling the company, whether it's a small group of investors, whether it's another PE fund. If an independent sponsor is able to go to a PE fund that, and let's say is not otherwise being marketed, absolutely. That is certainly one way that it could be done. So, what is the pros and cons of doing this whole model? One is the opportunity to utilize a skill set with a higher degree of autonomy while offering the ability to create personal wealth. And, in our capitalist society, this is about one of the ways that many people without large sources of funding can create their own personal level of wealth. The other thing is the opportunity for creating one of these structures without having to navigate a firm or setting up a whole fund and going out and raising money ahead of time, particularly if the individual doesn't necessarily have the track record to invest to get investors up front. There's less security laws up front when you don't raise the capital to begin with. And compared to having a committed fund, you usually have a lot more flexibility in what you can invest in as opposed to having a fairly rigid mandate. What are the costs? One is pre-deal expenses. You're out looking for deals. You're out, traveling potentially. You're certainly spending your time doing this. And those are the costs of doing this. Now, there's various ways that you can get compensated for those expenses. But usually, unless you have a backer prior to going to look for an acquisition, which is very unusual, usually those are expenses that the executive is going to have to come up with themselves. And there's a certain amount of due diligence expenses. And again, something to be negotiated with the capital providers, but there is potentially at least a certain amount of due diligence that one would have to go through in terms of identifying the deals. So what are the potential drawbacks to the sponsor? You make sure you have to have all the regulatory things in place. There's potential taxes that are a part of the equation. There's a potential clawback from investors, and then the investors' tax issues as well. The challenges in the independent sponsor model is potentially a volatile revenue. Nothing is predictable, and it's the classic case of capitalism where you take the risk, but have the potential for the reward. Closing the investments. It's not easy to go out and find and buy a company, and that's one of the risks that someone has to be able to be aware of. The other is making sure that you have you don't have investment bias. What does that mean? When you work as hard as you are to go out and find something, it's easy to say, well, let me just go buy something, and you don't really put the hard level of due diligence required, and then also making sure that you have the right entity set up. Now, why do investors get involved in this? And there's a huge motivation. And as I mentioned before, basically the dynamics are there's a lot of capital out there looking to invest. There's a lot of dry powder out there. And unless you're going to get in an auction that's where you're looking for a company that's being sold by a broker or an investment banker, you're bidding on the same companies that everyone else is. And what this allows investors to do is potentially look at off-market deals that aren't being bid up. And that's really where the value of the independent sponsor comes from. The other is the ability to negotiate the independent sponsor's economics. And we're going to get into the economics of what's in it for the independent sponsor, but this gives them some flexibility as well in their investments. The other is in the lower middle market, which is where a lot of these transactions are happening. And lower middle market has various definitions, but call it roughly $10 to $200 million of enterprise value. It's a very inefficient market. And a lot of investors prefer to focus on this sector of the market because of the inefficiencies and because of the ability to earn more money. The other thing is they get access to the independent sponsors. The independent sponsors are coming to the table with a high level of specialization in industry knowledge, and the ability to have access to that is very important. And then again, seeing proprietary or non-auction deal flows is one of the greatest values added, and potentially greater value or greater control rather over the investment terms, as opposed to working with a private equity firm that will basically control the terms. And then also complete control over the investment decision. And typically the investor will have a veto power as to whether an investment or an acquisition ultimately gets made. From the business owner's perspective, in dealing with an independent sponsor, there is a bit of a chicken and the egg. If you come knocking on someone's door and saying, hey, I'd like to buy your company and I'd like to negotiate the terms, one of the questions is obviously, okay, that's great, with whose money or how are you going to get the money? Now, given that part of, and this is a big part of the value that I'm going to bring to the process, you have a network of investors. While it is not necessarily guaranteed, at least there's a pool of funds out there that can be drawn upon to make these acquisitions. The other thing is you need to determine the viability of the capital. Is the capital really going to come? Is the transaction really going to happen? And does the sponsor have a track record where they've done this in the past? And the other thing is most, independent sponsors, given the limitations on capital, will back end the due diligence. So a lot of the heavy due diligence gets done the closer you get to closing. Okay, so now, very importantly, and hopefully the whole concept of the independent sponsor makes sense, what are the economics? There's a fair bit of variation. There's no formula that I'm going to share with you and say this is what the market rate is for an independent sponsor. It's a very inefficient market. But it is a little bit of private equity and venture capital investing. It's sort of a hybrid of the two. And typically, where the independent sponsor really makes their money is in the success of the investment. And often the way that the compensation is structured is they're called tiered distribution waterfalls, which means as the investors get returns on their capital, the independent sponsor will equally see their returns go up as well. So other things that are not uncommon is getting a deal fee or a transaction fee paid at closing. A lot of investors will pay various banks or brokers finder's fees for bringing deals. Then there's ongoing compensation. Nobody is asking an independent sponsor once they step in, make an acquisition, and run the company to volunteer their time. These are things that are also negotiated as either a day-to-day operator, being on the board of directors, or being an advisor. But again, really the tremendous upside that the executive or the independent sponsor will see is the promoter, the carried interest, that as the investors realize their money, that's where there's a huge opportunity for the independent sponsor to make money as well. So what are kind of typical economics? And as I said before, this is not that efficient a market. There's not hard and set rules, but typically, closing fees are between 1% and 5% of enterprise value. And typically a sponsor can roll that into their investment in the company. And we have another question here. Can you give us some ideas of fees relative to transaction size? Good question. The 1% to 5% is probably the thing that's, mathematically proportional to the size of the investment. And depending on sort of, if some of you are familiar with the Lehman scale or other benchmarks for what the fees are, that's usually a percentage of the size of the transaction. Then there's also a management fee, or this could be done in terms of, a salary and compensation and bonus. And those range in size from 3% to 5% of EBITDA. And then finally, as I mentioned, really where the upside is what's the promoter, the carried interest. And it ranges from a 20% carry for proven sponsors to 10%, which means, again, as you are able to realize returns for your investors, you will get a certain percentage of that return as well. Now, if you're going to become an independent sponsor, there's also restrictions, none of which I think are unreasonable, but restrictions that you should be aware of. One is time and attention. If someone's going to back an independent sponsor, they're usually asking you to make this your full-time job. It is kind of tough to do this as a side hustle, particularly when investors are putting in material or significant amounts of money. They want to know that you're committed and you're really going to spend your time doing this. The other thing is that the equity that you will get in this deal, which again, the realization of which is going to be either through dividends or through the eventual sale of the company, is going to vest over time. The goal of the investor is to make sure that there is a time commitment, and a vesting of equity over time is usually the best way to do that. The other thing is that there are certain things you could do to lose your promote, like leaving the company, for example. If you could kind of build this whole company, then you walk away from it, usually the promote goes away with you as well. Then there's ways to accelerate the vesting, and that's usually through the sale of the company, for example, and that's something that works. And then obviously making sure that any other activity you have is restricted, not only in terms of competitive, but just time and attention. And that's usually not atypical for the fiduciary requirements of an executive. How long you are typical in a transaction for? So private equity usually has an investment horizon of 3 to 5 years. That's textbook. Their goal is to make an investment, and then starting in year 3 and then maybe in year 5, they would like to exit that investment. And it's usually on the exit of that investment is where really the upside is going to come to the independent sponsor. Does that vary? Of course it does. All kinds of circumstances will happen to either accelerate or to slow that down, but 3 to 5 years is the typical amount of time. So, how is it that you can negotiate at the higher end of these scales than others? One is, if you are investing in an industry that you have extensive experience in, and they're really investing in your knowledge of that business and your networks and your contacts, that will usually allow you to negotiate better terms on the deals. Or if you've done this before, if you've been an independent sponsor and you've demonstrated your success at doing this, then will also potentially give you better terms. The other is, being a veteran operating partner or executive. If you go out and find a deal and convince someone to invest in it, but you're new to that industry, that's one thing. But if you can say, I've been in this business for a very long time, I know this industry well, I know the levers of making money, I know how to grow this business, you can also typically get better terms as well. But that having been said, if you're new to an industry but have access to a off-market deal, that is not an inconceivable transaction to pull together either. Finding the proprietary opportunity. I've said this multiple times. I'll keep saying it. This is really where a lot of the value is bringing those off-market deals to the table and being able to buy them at reasonable valuations. Now, I could give an entire 1 hour lecture on what are reasonable valuations for a company, but there's high end and medium and low ends to the scale of valuation, and the more attractive terms you bring to the table, obviously, the better the transaction. And that you have a very thoughtful growth and value creation strategy. In the instances where I'm currently working with independent sponsors who know industries very well, they have very crisp, very succinct, and very thoughtful ways of where they see the opportunities to make money. Either where there's inefficiencies in the industry, where there's untapped opportunities, or where they can, for example, infuse technology into an investment. And then it's the ability to tee up or add on additional acquisitions. Again, a big motivation of these investors you're working with is the desire to put capital to work. So it's not only doing initial acquisitions, but it's also being able to do follow-on acquisitions as well. Good ones. Now, the other thing in terms of the investors that I will typically work with and where I see the meat of the market is they're looking for companies that have a minimum EBITDA of $5 million. Can it go lower than that? Sure. Can it go higher than that? Absolutely. But typically $5 million is the minimum amount for an initial deal. And then additional or add-on acquisitions, they're looking at companies with at least $1 million of EBITDA. So this will give you just some sense of the size of the deals. And then, obviously being able to run a coordinated and systematic process to raise the capital. That if there are a group of potential investors, and again, that's a big part of where I step in and help this conversation, being able to get to the closing in a very thoughtful manner also bodes well for the economics as well. So what are the supply and demands? The private equity industry has become incredibly competitive. The returns have been there for many years, which is why a lot of capital is flooding into it. And they've also found that, up until recently, there's a lot of cheap debt out there that can fund and leverage these transactions. And there's a lot of dry powder out there. There's a lot of capital that has been committed to this area. And for that reasons, asset prices are getting bid up, which is where, again, for the umpteenth time, where the value is in finding these deals is so important. In terms of the deals for the independent sponsors, there are various fundraising cycles, and depending on where the economy is or how they're going through it, will determine. It's the ability of shifting general partner and limited partner bargaining power. A lot of the institutional investors in particular are working with their own sets of investors, limited partners. That will have an impact on it. And partnering with PE funds as well will also determine and their ability to buy directly. So, in conclusion, the goal is, a independent sponsor is acting like a private equity fund, but where the discretionary capital, to act like you have discretionary capital is not a good use of time. There's usually an inverse relationship between complexity and success. This is the classic example of KISS, keep it simple, stupid. And the more complexity you throw into that, the harder this becomes. Being disciplined. It requires a lot of patience. It requires a lot of resilience, and being able to stick with it is also very important. And focus on adding value. I mean, and this is the typical sort of advice you probably give to anybody. If you really create value, then success will follow. And it's a very inefficient market. The ability to both find and price deals is inefficient. The ability to negotiate your terms with your investors is very inefficient. So just go into this with a fair bit of flexibility. And sourcing compelling proprietary acquisitions is difficult and it takes time. And it's the best way to succeed as a new independent sponsor. And in fact, from the time I sort of, the starting gun went off and I started looking for acquisitions, it took me a year to close my first deal. So again, just to be realistic about what you're going to step into, that's what's required. So really, what I do is I work with and look for experienced executives. And while they know an industry that I probably have no idea about that industry, where I bring my background and my expertise is how to go through a process and how to structure a deal. This is my contact information. This presentation will also be available, both the recording as well as the document. Please contact me directly if you would like to get started, WhatsApp, text, email, what have you. And I'm very excited about continuing to expand my network of experienced executives to pursue this strategy. So with that, Chris, Charlotte, we've had a handful of questions come in so far. I'm going to leave my contact information up so anybody who's interested can continue to look for it. But would be happy to answer any other questions anybody has.
Hey Jim, I have a question. You mentioned it took you a year to get your first acquisition. Could you walk a little bit through that process of finding your first deal and the time it takes to find it to actually get through the acquisition?
Sure. And that really goes back to kind of that pre and post LOI exhibit that I put up. So the first was, and by the way, the industry that I was in that I explained at the outset, the for-profit post-secondary education business, was extremely hot when I started my search. So there was a lot of capital out looking for deals. Now, on the one hand, that made for a very successful exit on the previous deal. On the other hand, it made getting into that acquisition, getting back in the game a little bit more difficult. And I sort of looked at two sources of deals. Well, I'll call it three sources of deals. The first was the most obvious. There was a cottage industry of investment bankers and brokers that sold deals. And I kind of knew who they all were, as I'd been in this business for several years at that point. And I went knocking on all their doors and I wanted to know what they had for sale. The second thing I did, and I was also very active in the industry. We had, like most industries, we had an association. I was very active in the association. I knew a lot of people, and I frankly cold called a lot of people. Hey, I'm Jim. I'm looking for a school to buy. Are you interested? And every so often, someone would respond affirmatively to that question. We didn't ultimately buy the company that way. But I will tell you, the best way to buy a company, and this is ultimately what worked for me, is I knew the seller of the company that we bought. How did I know the seller? We had tried to buy her company for my previous company, and that deal didn't work out. But when we sold that company, and I had a great story to tell about what was it like working with private equity and all the upsides, I was able to call this individual back and say, "Hey, you remember we talked a few years ago? Sure, Jim, how you doing? Oh, I'm doing great. Hey, let me tell you what I'm up to, and see if this is something that's attractive to you." And that's ultimately what we went through. And then again, the first part of that was negotiating a letter of intent, getting the basic terms of the deal down. You don't want to spend a lot of time or money on transaction fees or lawyers or due diligence if you don't have the premise of a deal. But then once we got that letter of intent signed, then it was digging in deep into the due diligence. And in my industry, we had both regular legal due diligence as well as regulatory due diligence. And that's kind of, what I just described to you is kind of what took a year. You mentioned no independent sponsor SEC regulatory issues, but mentioned there may be some regulation over the course of the deal. Please elaborate. Now, I am not an attorney, and the last thing I would ever want to do is give legal advice. But often when you go out and you just raise money into a blind pool to go invest, there are SEC requirements in terms of the types of investors you're raising money from and whatnot. And then the other thing I would add, and again, I would probably say, talk to a corporate attorney. I don't find it's really front loaded with regulatory securities types of fees. But then also every industry is going to have their own set of regulations that you have to deal with. I was in a particularly highly regulated industry that required high levels of regulatory counsel. And then, just in the business environment that we all live and operate in, there's the typical HR laws, benefits laws, environmental laws, and any other sort of regulations or oversight that you may have to navigate along the way.
Interesting. Anybody else? Well, very interesting stuff. Very interesting stuff. And having bought and sold a few companies, I've kind of been through some of those pieces, but it's that's great.
Well, and as I said, one of the joys I get of doing what I'm doing is I meet some very interesting entrepreneurs that have been in some very esoteric industries that they've gotten to know well. A lot of the people I talk to are not aware this is an option, and it really is. As I mentioned in my background, I started as a CFO and then was able to move from that position into the CEO position and start my own platform. So particularly if people I'm talking to on this call are coming from more of a financial background, that is not a inconceivable way to leverage yourself into this. Again, I just hope I've shared with everybody and that there is this option out there, and would absolutely love to talk to you about it. So again, err on the side of getting in touch with me. We can discuss it. I can hear whatever ideas or thoughts you have and give you some feedback as to kind of viability and whatnot from that regard as well.
Sure.